So this brings me to discuss bridge assets and their unique place right now. And, a bridge asset is an asset that we don't necessarily expect to go to the upside, but it will maintain wealth. And so during this macroeconomic global transition that we're going through in earnest, the world is de-dollarizing as fast as I've ever seen and way faster than anyone expected. It is happening. This is why you have the Elon Musks of the world saying, the end for the US dollar. I mean, he publicly tweeted the end of the dollar is official. It is coming. So a bridge asset is an asset class that we expect to maintain relative wealth. Let me explain. When interest rates were 3% on average for a 30-year mortgage, let's just use that as a number. They were obviously lower as well. We can afford a payment on a $600,000 house, right? But when rates go up to 6%, we probably can only afford a payment on, likewise, a $350,000 house. So what happens is as asset values get basically retethered to true economic value, you will see some asset classes that diminish in total absolute value. They will come down. For example, that house, $600,000 coming down to a value of $350,000. Was it really worth $250,000 less? No. The interest rate made that house no longer affordable. That killed demand. That demand killed destruction, basically brings prices down. This takes a while. You haven't seen that happen in the housing market yet, but that is purely because we have such a low inventory. As soon as the inventory is somewhat recovered, you will see values coming down. So we might suggest, as part of a bridge asset strategy, to invest in some real estate. And the typical investor reaction at that point would be, but Rebecca, you've just told me that the asset class might go from 600 to 350. I'm going to lose 250,000, so almost 50% of my value I'm going to lose, and you're telling me to invest. That doesn't make sense. And that's true, unless you look at what's actually happening. So when you have a currency transition, these kinds of macroeconomic consequences are universal. So what does that mean? That means if I'm investing in a stock at 100 and it drops to 50, I've lost $50 on that stock. I've lost half my value. But if I'm buying a $600,000 house and it goes to 350, because that is happening universally across real estate in America, my relative net worth is preserved. I have not lost just my stock portfolio that I now have to recapture. I have basically had my real estate reevaluated in the new currency system. And because it is a reevaluation in a new system, my relative net worth to everyone else is preserved. So even though it's not an asset class that might pop to the upside, like some of the asset classes that we are leveraging that are going to expect it to pop to the upside and actually make us better off through the transition than before, what Wall Street is doing is telling Main Street to stay the course and to leverage asset classes that we know are overvalued because they've been untethered to real hard true values, and they will come down. And it is not a relative come down because you might be in Apple and the other guy might be in General Motors, and the discrepancy will not be universal. So we have to very much be careful with traditional asset classes during any kind of currency transition, and this is why.